little comeback for stocks again today. Things kind of simmering a little bit ahead of the big tariff unveil in the middle of this week and employment data on Friday. What was interesting today was the way stocks shrugged off what has basically been kind of a bond market freakout in the last week. Yellow lights still hold across my risk radar. Bonds look really close to going green. Equities have been on the brink of red because of that NASDAQ dip to lower lows. But the fact we have held in the March lows for the S&P gives me still some lingering hope that maybe we could turn into something stronger for equities, but we'll cross that bridge when we get there. Few things on that front. Firstly, though, Treasuries. The bond market is going through a bit of a panic here. Today we saw a big rally after job openings dipped a little bit, but we're still in pretty familiar territory, around 7.5 million. And then we also saw the manufacturing data looking quite ugly, but it's also been ugly for some time. That being said, new orders dropped a lot and prices paid went up a lot. But also being said, that is the epicenter for tariff stuff, pricing on manufacturing goods and imports. A lot of that's going to show up in manufacturing that we've already seen in sentiment as well. But the bond market said it doesn't matter. This is a problem. We got 10s to the 3-month rate coming back to this chart we've talked about a good bit. This is on the verge of further contraction that you just don't want to see. The fact that we got this spread now back to the lows of March and battling it is telling you the bond market is saying we're in a bad combination of growth and inflation again. But this is also reflecting the potential that the Fed just may not cut, and perhaps that's too priced in for June, as we heard from Colin Martin and the team at Schwab Center for Financial Research. Cuts later in the year, maybe the second half, but June is not it. So that could possibly also just be crunching the curve a little bit. But keep in mind, if we're not having to cut for the right reasons, then sometimes that yield curve can give a little bit of a false signal. And generally, the bond market has been tough. As you know, last week, I was looking to the bond market as a sign of actual optimism because we had yields moving higher, but then stocks sold off. So the message of bonds and the dollar, too, have been difficult to trace in their connections because they have been shifting a little bit. But here's generally what I'm still going with. Higher yields, a good thing. Lower yields, a bad thing. Firm dollar, good. Higher dollar may be good. Lower dollar, generally bad. That's been the kind of tariff regime here throughout the last month. Some of that stuff has shifted a little bit, but this is still what I'm watching through the next 2 days. Look at still on the TLT. If you look at the long-term bonds, you still have a downtrend. This is price now, of course, but that's still encouraging. If we see further moves in bond prices higher, the green light goes on bonds, and it's probably not a good message for stocks. Equities, though, can go a long time ignoring the message from bonds because bond market's job is to kind of freak out a little bit early, in case you didn't notice over the last couple of years. So, in lieu of trying to read the tea leaves from the macro, let's just go with the price action. Tesla is your guiding light still. This thing is amazing, Tesla. You still have the higher lows here, and this is not exactly the best consolidation pattern, right? You still kind of have the lower highs, but that being said, Tesla does do these triangles a lot, and I've talked about that, and if it does break to the upside, it could be very encouraging. The fact that we got stocks back down to the lows on Monday, but then Tesla held this little short-term range here, it is your guiding light for risk. If we're going to get a move, Tesla has been leading it, but Bitcoin too I want to watch because BTC is starting to firm up a little bit. The two look pretty similar. I mean, these are basically your two horsemen of risk appetite. These charts are not wonderful. They're still under a lot of deep compression longer term, but there are little drops of optimism still after we held the March lows for equities. I'll see you tomorrow.